It's April 2020, 6 years ago. Oil prices went negative. Traders were paying people to take barrels off their hands. Analysts at every major bank declared the death of the oil industry. Electric vehicles would finish what the pandemic started. Demand had peaked. The world had changed forever. 18 months later, oil was above $120 a barrel. The same analysts who told you oil was dead were now explaining why it was scarce. The same forecast that missed the bottom by 150%, missed the top by 40%. The same institutions that published these reports, Goldman Sachs, JP Morgan, the rest, they have a legal disclosure buried in their research. It says, and I quote, their analyst is not independent from their trading and marketing activities. In plain English, the people telling you where oil is going are betting on oil. And there's no legal requirement that their published forecasts reflect their actual belief. This isn't conspiracy, it's disclosed. It's legal. And if you don't know this, you are playing a game where the rules were written by people betting against you. Here's the thing about markets. There's something you can only learn by living through it. Anyone can read about relationships, the psychology, the patterns, the advice, but you don't actually know relationships until you've been through one, until you've experienced the early excitement, the inevitable disappointment, the work it takes to rebuild, and the wisdom that only comes from watching a full cycle complete itself. You have to live through the whole thing, beginning to end, before you can recognize where you are in the next one. Oil markets are exactly the same. I've spent decades in this industry. I've watched prices collapse and people declare the end of oil. I've watched prices spike and people declare permanent scarcity. I've seen fortunes made by those who understood the cycle and fortunes lost by those who only knew one chapter of the story. Right now, in January 2026, I'm watching something I've seen before. Banks are unanimously bearish. Headlines: war of oversupply. Venezuela is treated as imminent relief. Analysts who have never operated a well, never arranged financing during a downturn, never watched a producing asset get sold for scrap, they are making confident pronouncements about where we are headed. They've read the spreadsheets, they've seen the headlines, they understand the theory, but they haven't lived through the consequences of what happens when everyone believes the same narrative at the same time. Today, I want to share what experience teaches you that theory cannot. Not predictions, not fear, just the perspective that comes from watching these cycles unfold and understanding that what feels permanent today never is. Let's start with Venezuela. You've heard the headlines. The regime has changed. American companies are moving in. And suddenly, everyone is talking about Venezuelan oil flooding the market. 303 billion barrels. That's the number you keep hearing. The world's largest reserves, more than Saudi Arabia. Here's what experience teaches you about that number. Oil reserves on paper are not oil in your gas tank. Venezuela claims 303 billion barrels. Independent analysts, people I trust, people who have actually worked these formations, estimate the economically recoverable figure at somewhere between 27 and 110 billion barrels. That's a gap of nearly 200 billion barrels. Why such a dramatic difference? Venezuelan crude is not like Saudi crude. It's not like West Texas Intermediate. It's extra heavy, almost tar-like. It doesn't flow through pipelines. Without being diluted with lighter hydrocarbons, it requires specialized refineries that exist only in a handful of places globally. The production costs run $38 to $70 per barrel before you even consider infrastructure problems. The infrastructure problems are severe. PDVSA, Venezuelan state oil company, estimates it would take $58 billion just to restore infrastructure to previous production levels. Rystad Energy projects $183 billion through 2040 to reach 3 million barrels per day. The pipelines haven't even updated in 50 years. Loading a supertanker now takes 5 days. It used to take one. Refineries are operating at 10 to 20% capacity, and over 30,000 petroleum engineers have left the country. How long does it take to rebuild an oil industry under these conditions? Look at Iraq. After 2003, it took 7 years to add meaningful production, 12 years to reach previous highs. Look at Libya. 14 years after regime change, production is still only 32% of its peak. There is no historical precedent, not where regime change led to rapid oil production increases. In most cases, production fell for years before recovering. Bob McNally at Rapedian Energy Group, someone who understands this industry deeply, put it simply: Venezuela can be a huge deal, but not for 5 to 10 years. So when you hear that Venezuelan oil is about to flood the market, ask yourself, says who? Based on what timeline? Using what capital? The answer matters, because if those barrels don't arrive when expected, and they won't, the bearish forecast built on that assumption will prove wrong. This brings me to a more difficult topic. In this moment, I do not believe mainstream oil market narratives are reliable. I say this carefully. I'm not suggesting coordinated deception. I'm suggesting something more subtle and, in some ways, more dangerous: a convergence of institutional incentives that produces a distorted picture. Consider what's happening right now. Banks are publishing bearish oil forecasts, prices falling to the low 50s, even 40s. These same banks operate commodity trading desks that generate billions in profits. Goldman Sachs, in their own disclosures, states explicitly that their research is not independent from their trading and market-making activities. This isn't conspiracy. It's disclosed. It's legal, but it should inform how you interpret their forecast. Consider also the political incentives. Lower oil prices calm inflation fears. They support consumer confidence. They strengthen the dollar. They create favorable economic optics in an uncertain time. There's enormous institutional pressure across government, finance, and media to maintain the narrative that oil is abundant, that prices will stay low, that the energy problem is solved. I've lived through enough cycles to recognize when narratives diverge from fundamentals. In 2020, when oil prices went negative, the narrative was permanent demand destruction. Electric vehicles would end oil within a decade. The pandemic had changed everything. 18 months later, oil was above 120. In 2015 and 2016, the narrative was shale abundance forever. American production would grow indefinitely. OPEC was irrelevant. By 2022, we were draining strategic reserves to manage prices. The pattern is consistent. When everyone believes the same story, the story is usually wrong. Today, banks unanimously bearish. Headlines emphasize oversupply. Venezuela is treated as imminent relief. Experience teaches me to be skeptical precisely when consensus is this strong. Now, let me be clear about something. In the short term, lower oil prices are genuinely helpful. Consumers benefit at the pump. Business see lower input costs. Inflation pressure ease. Central banks have more flexibility. Politicians can claim credit for economic relief. These are real benefits, and I don't dismiss them. The question is, at what cost? There is an old saying in commodity markets that I found reliably true over decades. The cure for high prices is high prices, and the cure for low prices is low prices. Now, what does that mean? When prices are high, investment pours in, production expands, eventually supply catches up with demand, and prices fall. When prices are low, investment dries up, production declines, eventually supply falls short of demand, and prices spike. We are in the second phase now. Low prices feel good today, but every month of low prices destroys the investment needed to maintain production tomorrow. The numbers here are stark. Global oil fields decline at 5.5 million barrels per day annually. That means the industry must find and develop 5.5 million new barrels every year just to stay flat before any demand growth. The reserve replacement ratio, new discoveries versus production, is running at 16% for every 6 barrels we produce. We're finding one. Annual upstream investment is running 300 to 400 billion short of what's needed to maintain supply. I've seen this setup before. I saw it in 2009 when prices crashed below $40 a barrel and everyone declared the end of commodity supercycle. With 2 years, Brent was above $100 a barrel. I saw it in 2020 when prices went negative and analysts wrote obituaries for the oil industry. Within 18 months, we were rationing diesel. Low prices today feel like a gift. They are, in fact, a loan, and the repayment terms will be severe. Here's something else that gets overlooked in the abundance narrative. Cheap energy stimulates demand. This isn't theory. It's basic economics and observable history. When gasoline is cheap, people drive more. They buy larger vehicles. They take more trips. The economic incentive to conserve disappears. When industrial energy is cheap, manufacturing expands. Petrochemical production increases. Countries that were energy constrained suddenly have room to grow. Look at what's happening globally. Asia continues to industrialize. India alone will add demand equivalent to a major European country over the next decade. Southeast Asian manufacturing is expanding. African nations are beginning the energy-intensive phase of development that China and India went through. And then there's the artificial intelligence. The data centers powering AI consume enormous amounts of electricity. The build-out underway right now. The chips, the cooling systems, the redundant power supplies represents energy demand that didn't exist 5 years ago and will grow exponentially. Meanwhile, what happens to alternative energy when oil's cheap? Electric vehicles adoption slows. The payback period on EV purchase extends from 4 years to 7 years when gasoline is $2.50 instead of $4. Solar and wind projects face tougher economics. Investment in alternatives gets deferred. The International Energy Agency, which spent years promoting peak oil demand, has quietly reversed course. Their latest projections now show demand growing to 113 million barrels per day by 2050 under current policies. That's 10 million barrels per day higher than today. So we have an environment where supply investment is being destroyed by low prices. Demand is being stimulated by low prices. And the narrative says abundance is permanent. If you've lived through cycles, you recognize this pattern. It doesn't end with stable, low prices. It ends with a spike. Now, we need to discuss something oil analysts often underestimate and political analysts often oversimplify: the human element in geopolitics. OPEC Plus, Russia, Iran, Saudi Arabia, these aren't abstract entities. They are nations led by people who remember being disrespected, who calculate long-term interest, and who respond to perceived humiliation in ways that don't always appear on spreadsheets. Consider the current moment from their perspective. The United States has, through various means, pushed oil prices down significantly. This serves American interests, lower inflation, stronger dollar, economic leverage. But for oil-producing nations, it represents something different. Saudi Arabia needs roughly $96 per barrel to balance its budget. Some estimates say higher when you include their development programs. They are currently running deficits exceeding 5% of their GDP. Russia has built its war economy around certain oil revenue assumptions. Iran is under maximum pressure sanctions while watching American forces operate in their former allies' territory. How do powerful nations respond when they feel conquered? They don't respond immediately. They calculate. They form alignments. They wait for moments of leverage. They remember. I want to be careful here. I'm not predicting conflict or dramatic retaliation. I'm simply observing that oil policy is never just about oil. When you pressure OPEC Plus to increase production against their economic interests, you're not conducting a simple supply negotiation. You are conducting foreign policy with nations that have long memories and significant capabilities. Saudi Arabia holds 2 million barrels per day of spare capacity. That's 60% of global spare capacity. They can flood markets or starve them. The choice is theirs. Russia supplies energy to nations that aren't participating in Western sanctions. They have leverage we pretend doesn't exist. Iran has asymmetric military capabilities through the Middle East. 20 million barrels per day transit the Strait of Hormuz daily. The scenarios don't need to be spelled out. My point is not to alarm, it's to inject realism. Anyone who tells you they know How this plays out is guessing. But anyone who ignores the strategic calculus of wounded powers is being naive. I want to say something about the current administration because I believe in being direct. I support President Trump. I believe his intentions regarding energy policy are oriented toward American strength and prosperity. The effort to bring prices down and project confidence is understandable and, in the short term, has delivered real results. That said, oil markets punish oversimplification. The belief that prices can be forced down through policy pressure, that Venezuela will deliver quick relief, that OPEC will comply indefinitely, that Shell will grow forever, these beliefs collide with physical and economic realities that do not negotiate. I've watched administrations of both parties make similar assumptions. They all eventually encounter the same constraints. You can influence oil markets. You cannot control them. You can shape narratives. You cannot change geology. You can pressure OPEC. You cannot eliminate their leverage. My concern is not with the intent. My concern is with the timeline. Short-term success in lowering prices creates long-term vulnerability. Every month of suppressed prices destroys more investment, accelerates more declines, and sets up a larger eventual correction. The question isn't whether the current approach is working. Today, it clearly is. The question is whether we are trading short-term relief for long-term crisis. And that question deserves honest discussion, even from supporters. Let me close where I began, with experience. I've watched oil crash and heard the predictions of permanent abundance. I've watched oil spike and heard the predictions of permanent scarcity. I've seen fortunes made and lost by people who confused the current phase of cycle for the entire story. What I've learned is this: the people most confident about oil markets are usually the people who've only seen one chapter. The analysts who lived through 2020 but not 2008 have a different view than those who lived through both. The traders who saw the Shell boom but not the 1998 crash draw different conclusions than those who remember both. And the commentators who never operated a well, never arranged financing during a downturn, never watched a producing asset get sold for scrap, they have theories, they don't have experience. Right now, the consensus says oil is abundant. Venezuela will add supply, OPEC is weakening, Shell will grow, prices will stay low. I've heard this consensus before, almost word for word, in 2016, in 2020, and in 2009. Each time, the consensus was wrong. I'm not making predictions today. I don't know when the current narrative breaks. I don't know what the catalyst will be. I don't know how high prices will go when the cycle turns. What I know is that cycles always turn. What I know is that the longer prices stay low, the more violent the reversal becomes. What I know is that the people positioning for the current narrative are not the same people who will be positioned for what comes next. If you've only seen one chapter of this story, consider that you might be missing something. If you are making decisions based on headlines rather than fundamentals, consider who wrote those headlines and why. If you believe this time is different, consider how many times that phrase has preceded exactly the outcome it dismissed. I don't ask you to agree with me. I ask you to think like someone who has lived through cycles. Because if you haven't, if this is your first, you will. And when you do, you'll understand why experience teaches lessons that theory never can. Thank you for listening. I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. Please comment. Please like, even if it's just a word. It helps with the algorithm because the truth is not widely spread because the algorithms hate the truth. All right, guys, we'll talk soon. Thanks.